What's up guys, it's Humphrey here. So in this video, we're gonna go over 10 common investment decisions that are hurting your overall returns. If you're able to avoid these, you're gonna maximize your returns and also optimize for long-term wealth building. So let's get right into the number one item that is killing your returns, and that is buying individual stocks. Most people hear a stock pick from their friends or family, they hear it from the media, or they just wanna get into investing, so they invest with a brand that they are familiar with, like Nike or Coca-Cola. The problem is, retail investors like you or I are horrible at picking stocks, and professional traders aren't that much better either. There was a famous academic paper that studied 19,646 day traders, and over the course of 300 days, it found that 97% of all investors actually lost money in the stock market. And in another day trading paper from UC Berkeley in 2011, it concluded that in an average year, over 360,000 individual investors day trade, but only about 15% of them were able to profit after accounting for trading costs. And famously, it's no secret that 95% of finance professionals can't beat the market either. Even with these statistics, people go to the stock market casino every single day and try to turn their money into a larger sum of money. There are stories of people on Wall Street bets turning 3K into 300K into a single month, and then the media likes to glorify these day traders that made a ton of money, for example, like back in the GameStop days in 2021. But for every single one of these traders that turns a once-in-a-lifetime profit, there are hundreds, if not thousands, of other day traders who lose it all. For example, one Reddit poster turned $24,000 into $26, and another turned $97,000 into basically nothing over a single short year. There are probably many more that just don't post about it either, because the internet is not a place where you post your losers, you only post your winners. I think individual stocks definitely have a place in your portfolio. However, if you're just going all in on 1 to 3 different volatile stocks trying to turn $100 into $100,000, chances are you're not going to do very well. The more practical solution is just to buy a well-diversified mix of ETFs or index funds with a low expense ratio, and we'll talk a little bit more about that later. But that brings me to my second investment decision today that could be costing you some returns, and that's actually not paying attention to an expense ratio. An expense ratio is the yearly fee that an ETF or index fund will charge you for investing in that fund. A typical index fund from Vanguard, for example, will charge you 0.05% per year. So on a $10,000 investment over the course of a single year, you pay about $5 in fees. However, there are some ETFs and mutual funds and index funds out there that charge you a lot more, upwards of 0.5% or even 1% or more. When the expense ratios are that high, they really start to eat into your returns. So a 1% fee on a $10,000 investment every year is about $100. And just to show you how that can really affect your overall balance, the SEC has this graph right here, and it says right here that in 20 years, a 1% annual fee will reduce your portfolio value by $30,000 compared to that of a portfolio with a 0.25% annual fee. So just a 0.75% difference in your expense ratio or your portfolio fees can make a really big difference. A popular ETF with a really high fee these days is the ARK line of ETFs. So the ARK Innovation ETF famously has a 0.75% expense ratio. Honestly, I think that's incredibly high. I think anything over 0.5% is incredibly high, especially if the returns don't really justify those fees. It's really not in your best interest to pay these high fees, and these fees just go to a fund manager, and these fund managers make a ton of money, and guess what? They don't beat the market. All right, moving into number 3 on our list today, and that is trying to time the market. When you're thinking of investing and you look at the stock market and it's close to an all-time high, you might want to wait a little bit before you start investing. But the truth is that nobody can really time the market, and if you just sit on the sidelines waiting for a dip, that dip might not actually ever happen. By April 1st, 2021, it closed over 4,000 for the first time, setting a new all-time high. Had you sat on the sidelines until now, you would have missed out on the run-up from 2021 to 2022, as well as the fact that the S&P 500 these days, it trades well over 5,000. Charles Schwab did a study from 2000 to 2020 and compared 5 different investing styles. One where it compared someone who had absolutely perfect timing every single time, and then 4 other investing styles. Surprisingly, even the person with horrible timing, as you can see with the results right here, they still made close to as much as 3 times as much as the person who just sat around in cash. So that's how much your inaction could be costing you right now. Basically, the opportunity cost of not investing is just too great. Obviously, the perfect timing person won out here, but really it's not by that much when you compare it to the person who invested immediately or dollar cost average. So yeah, don't try to time the market, but try to optimize your time in the market, and that's the old adage that definitely rings true. All right, something you should try to time though is how long it takes you to actually hit that subscribe button down below. I timed that it takes about 0.1 seconds, so if you can beat my time, please let me know.
He's a freak. He's a fast killer.
All right, I hope you pressed that button, and let's get into investment decision number 4 that could be costing you some returns, and that is hiring a professional financial advisor. But hear me out here. The caveat here is that financial advisors are really good for planning. So if you need estate planning, tax planning, or retirement planning, etc., they're your person. But when it comes to pure stock market returns, I would probably not go to a financial advisor if that's what I was looking for. When I used to be a financial advisor, investing was probably the easiest part of the job. All we did was put you in a standardized product that would probably match market returns. And honestly, we would just put you in ETFs that tried to match the S&P 500 ETF, if not a little bit better, but oftentimes, as you might know, it's hard to beat the market. And the shadier financial advisors, they would put you in mutual funds with high expense ratios or front-loaded fees where basically your fees would go towards the commissions of that advisor. I still think a financial advisor is a great person to have in your corner, especially if you need that planning type of help, but for investing alone, I don't think it's worth it. And oftentimes the fee structure for a financial advisor just doesn't make sense because they charge you generally a percentage of your assets under management. If you are gonna go with a financial advisor, make sure to look into the flat fee option. That way, no matter how much assets you have, they get paid the same. There are other options out there, such as financial advisors as a service, and many companies these days do this. Okay, the number 5 investing decision that could be killing your returns is emotional investing. If you invest based on emotion, you're basically giving in to your behavioral impulses, and oftentimes your behavioral impulses are not the correct calls. So there's something called the Fear and Greed Index, which actually gauges market sentiment. It's based on the idea that when people are fearful, stocks often trade below what they're worth, and then vice versa, when people are very greedy, stocks trade for much more than what they're worth. Because so much of trading and investing can be psychological, oftentimes our impulses are the opposite of what we should be doing. This particular metric or index has been pretty accurate in the past. So for example, most famously during the COVID-19 pandemic, the index fell to an annual low of 2, which is extreme fear, when stocks plunged a ton during that week of lockdown. These days, the market sits in the greed category as investors are looking to capitalize on the run-up of the market as of late. Investing based on your emotion, either fear or greed, is the reason why people tend to buy at the very, very top and then sell at the very bottom. The best thing to do, in my opinion, is just to invest in a well-diversified basket of stocks and then set it and then just forget it. That brings me to point number 6 today, which is that when you are actually starting to invest and getting into investing, you shouldn't actually be optimizing for returns. Morgan Housel, the author of Psychology of Money, actually argues that you should optimize for endurance when it comes to investing. So let's actually take a listen to what he has to say.
I think it's extremely hard to beat the market, and very few people will do it. But I think there are really smart people who can do it, and people who I know who I could invest with. The reason I don't is not because I don't believe it can be done. It's because the variable that I want to maximize for in my investments is endurance. If I can just earn average returns for an above average period of time, it's going to lead to amount of success that will literally put you in the top 5% of investors.
And this is super true. As long as you stay invested over a long period of time and you get above average market returns, you're going to do way better than 95% of people out there. I also resonate with the idea that when it comes to endurance in investing, it may look like the fact that you might lose your password.
Your book taught me that successful investing is when you lose the password to your investment account.
Yes, that's exactly it.
I don't actually think you said that in there, but that's like, when I lose the password to my investment account, I'm so proud of myself.
Yeah.
Because it means I haven't checked it in forever.
So that's the host of the Diary of a CEO podcast. His name is Stephen Bartlett. And basically what he's saying here is that when you lose the investment account password that you have, you're just not checking your investments, which is a pretty good thing. That means you've actually set it and actually forgotten it. You're focused on the parts of life that matter more. Perhaps you're spending more time with your family, you're focused on making more money via your active income, and you're just experiencing life in general. This also plays into the idea of not emotionally investing, and it's definitely true. If you don't have the investment password, you can't make any trades, so therefore you are taking your emotions out of it. So I love that quote and podcast with Morgan Housel, and it really shows you how long-term minded you should be when it actually comes to investing. Mistake number 7 that could be killing your returns is not reinvesting dividends. So when a stock or fund that you own pays dividends, you can actually take it in cash, or you can decide to reinvest those dividends and purchase more shares of the underlying asset. If you don't need cash at that exact moment, I would definitely reinvest the dividends so that you can compound your future returns. So this is just basically a setting in your brokerage account. Whenever you get paid a dividend, it will automatically get reinvested into whatever underlying asset paid that dividend and just buys more fractional shares. There are many benefits to this. Most importantly, you are consistently accumulating the underlying fund or stock that you bought. Many companies will offer a dividend reinvestment plan, also known as a DRIP, and with these plans, there are usually no commissions or brokerage fees for the shares that you buy. You can sometimes get discounted prices, and they usually accrue in the form of fractional shares. So to actually do it is pretty easy. You just want to make sure that setting is toggled correctly in your brokerage account. So for example, I've pulled up my Fidelity account right here. You just want to make sure that it says reinvest in security. You can see that I've done it in all of my holdings right here. And if you actually click into AbbVie, you can see that for my holding of AbbVie Pharmaceutical that I have it selected here. And you can always update this in your brokerage account. All right, investment decision number 8 that could be costing you some returns is having a misaligned asset allocation for your age. Asset allocations can be very different for everybody. However, this talking point in particular is going to be quite general based on broad assumptions. So in investing, you just want to make sure that your asset allocation is actually tailored towards your goals and your risk tolerance. So if you're the age of 18, for example, and you're trying to build your wealth, then I wouldn't have my asset allocations in 100% bonds unless you're just completely risk averse. And vice versa, if you're about to retire at the age of 65, my asset allocation is probably not going to be just in 1 to 5 individual stocks. I'll link to my video down below on what your portfolio should look like by age if you want more information, but the summary is basically the following. When you're young, you want to be risky because you have much more time to make up for any risks that might not go your way. Then as you age, you want to shift your asset allocation towards more of a moderate approach. Perhaps you add some fixed income instruments like bonds. And then finally, right before you retire, you're probably going to be the most conservative. Fidelity did a study on asset allocations and their impact on long-term performance. And I think one interesting thing to note here is that the worst 20-year return annualized for any asset allocation is still positive. So that's a really good thing if you're questioning whether or not you should invest in the market, which is that for all rolling 20-year periods, it's always returned positive. All right, we touched upon this a little bit earlier in the video, but this is to expand on my point of individual stocks, which is investment mistake number 9 killing your returns is options trading. An option is a type of security that allows you to speculate on the price of a stock with a ton of leverage. For example, a call option gives you the right, but not the obligation to buy a stock at a certain price in the future for a pre-specified fee. So if you wanted to buy Apple stock for $150 per share in a month's time, you might be willing to pay a $15 fee for that right. The problem is though, is that if Apple stock is not trading for $150 plus the premium that you paid, the $15 fee, then you are technically underwater. Options are highly leveraged and there's a time decay factor, which makes them incredibly difficult to trade and make money on for the average investor. Oftentimes, options will make the stock market feel like a casino instead of a place where you can invest your money for long-term returns, and therein lies the problem. While it can multiply your potential gains by huge multiples, most people oftentimes will lose money on options trading. So here are some screenshots from my personal options trading journey. You can see that I got really lucky with options in GameStop of 2021, and I had earned $16,000 in profit in the month of January 2021. But then if you just look at my all-time history of options trades since, that you can see that most of these bars are in the red, which means most of the time I'm trading options, I'm losing money. So this summary page is actually a new feature from Robinhood where they show you your lifetime profit and loss, and this was really eye-opening for me. So all my gains that I made in options from 2021, these two big bars on the left here, were evaporated over the next few years. And even though this is my speculative stock market account because it is in Robinhood, you can see that I am clearly not a very good options investor. My stock market returns, on the other hand, since 2021 have been great because I'm mostly just invested in index funds as well as big companies like Apple, Meta, and Google. But clearly options trading is not for me. Actually, once I saw this lifetime P&L, I've decided to stop options trading altogether, and they're probably pretty horrible for the average investor as well. And that brings me to my last investment decision today that could be costing you a ton of returns, and that is not investing in index funds. Instead of playing options or trying to pick a moonshot stock, all you really have to do is invest in a low-cost, well-diversified index fund that tracks the market. Index funds like Vanguard's VFIAX or VTSAX, they track the largest 500 companies in the US, or they track the entire US stock market. So by buying that one fund, you're getting exposure to all of that fund and what it owns. Most index funds charge a really low fee, as I mentioned earlier in this video, and famously VTSAX, I think it charges about 0.06% or $6 for every $10,000 that you have invested. Index funds are really easy to buy in any brokerage, and if you can't buy the index fund, you can always opt for the ETF equivalent. In fact, Warren Buffett has been known to say that people are much better off buying a cross section of America and forgetting about it when it comes to investing. So if you're in it for the long haul, whole, make sure to try index fund investing. And with that said, you guys, thank you so much for watching this video. Make sure to subscribe to the channel so you don't miss an upload from me. And also check out my next video right here. It's how to get invested with index funds for beginners. And I think you will really like that video. And if not, I'll see you in a future video. All right, peace.